Good afternoon and welcome to the SYLVANIA Platinum Limited full year 22 results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Jaco Prinsloo, CEO, and Luan Kaminati, CFO. Good afternoon.
Good afternoon, and thank you for the introduction, Paul. And as Paul said, welcome to everyone to our 2022 financial year results presentation. And I'll be joined today by Luan Kaminati, our CFO. Myself and Luan have respectively been with SYLVANIA for about 10 and 13 years. So hopefully we can answer your questions at the end as well about the business. And we would like to take this opportunity to highlight some of the features of our current year's performance. Just as an orientation, starting off, overview of our business is SYLVANIA have a suite of assets that consists of both our current cash generative assets, which is called our SYLVANIA dump operations, which are situated on the eastern and western limbs of the Bushveld complex respectively in South Africa, as well as some owned exploration assets for which we own mineral rights up on the northern limb of the Bushveld complex. So most of our capital, cash and profits currently are generated from the SYLVANIA dump operations, and it is these proceeds from these operations that we've been reinvesting over the years to grow our business from the first single operation in about 2008 to the 6 operations we have at the moment. It further enables us to reinvest in growth projects and also now to develop and unlock value in our exploration assets, and more importantly enables us to return value to our shareholders in terms of both share buybacks, dividends and growth, which we'll discuss in a bit more detail as we go through the presentation. Just looking at the year past and focusing on some of the highlights, I think first of all, looking at our 67,000 ounce production for the year, it's 4E ounce production, which I'm very proud of. I think it's a sterling effort from the guys, especially during the second half of the year after we've had some operational challenges in the first half, as we discussed and disclosed during our interim presentations, and that mainly related to the tailings dam related interruptions at Lesedi mine, and then also run of mine feed grades at our Mooinooi mine. But nevertheless, a strong performance, and especially commendable in that period is our Tweefontein operation that posted record monthly, quarterly and annual record results for the operation during this period that really assisted us to come through strong at the end of the year. Looking at the basket price at $2,890 an ounce that we realized for the financial year, it's certainly not an unattractive price compared to historical levels. However, it is unfortunately 23% down on the previous financial year, granted that the previous financial year saw us hitting record PGM prices, and the fact that it pulled down slightly in this current financial year obviously had an impact on our financial performance, which Luan will talk about later. I think from a sustainability performance, probably the biggest highlight for us here is worth mentioning is a 10-year lost time injury-free performance by our Doornbos operation. You know, we achieved that in June, and it's also been recognized by the Mine Metallurgical Managers Association of Africa as an industry award, best in class performance. So very well done there. Focusing towards some of the more financial parameters, you know, we've been very proud of the 2.25 pence windfall dividend that we have paid, declared at the interims and paid in April this year. We've managed to buy back 6.6 million shares during the years as part of a share buyback program. And, you know, after the share buybacks, windfall dividend and, you know, servicing our capital commitments and other stuff, we ended up with a cash balance of around $121 million at the end of the financial year. And through this, based on the strong production performance and diligent capital management, we, the board, have been able to declare a further 8 pence dividend that would be payable in December this year in lieu of the annual year performance. So overall, I hope that would also be very positively received by our shareholders. If you look at some more detailed operational results, the PGM feed tons were slightly down, and as I said, the primary reason for that was the Lesedi tailings dam related disruptions that have since been resolved. All 5 our other operations have either met or exceeded their throughput targets for the year. So overall, very good performance for the year. Recovery was marginally down, not because the operations performed poorer, but because of a higher contribution of ounces from one of our lower recovery efficiency operations. And then finally, it resulted in overall ounces in a 4-year basis being down about 4%. And I think also worth noting from a reporting perspective that the 67,000 ounce 4E production equates to about almost 86,000 ounces 6E, as some of our peers in the market report on a 6E basis. Obviously, because of the basket price reduction, you can see the net revenue, EBITDA, and profit figures all have a year-on-year decline. And Leanne will touch more on the details of that in the finance section of the presentation. And as a remaining focus area, also the group cash cost that increased about 19% year on year, and we'll touch on that. But primarily, we have a large fixed cost base that do that, and then the global inflationary pressures that the industry as a whole faced certainly put pressure on us as well. Finally, again, we're very proud of the 8 pence dividend, annual dividend that we've declared. It's a 100% increase on the 4 pence dividend declared in the previous financial year. And adding it on to the 2.25 pence windfall earlier, it's over 10 pence return for the year. From an ESG point of view and perspective, I am very proud of the performance of our team this year. Particularly the standalone ESG report. That is the first time that Sylvania will be issuing a standalone ESG report to be published on our website this year alongside these results, to give shareholders an indication of what exactly it is we're doing into ESG and to highlight some of our particular achievements in that regard. And as I said, Leanne and the team has done a great job, and she's going to just take us through more details of the specific ESG components later in the presentation. So if we briefly just focus then on the detailed operational analysis and result, and looking at how the individual operations performed over the year. I've mentioned already the Lesedi and Mooinooi impacts, and it's evident from the graph for the 2022 composition, where you can see the lower contribution from Lesedi, the yellow bar at the top, and also Mooinooi. And as I said, mostly resolved at the moment, and you can see going forward how those 2 operations proportionally contribute more to our profile going forward. In addition to the operational challenges being resolved, we continue in terms of our process efficiencies and unlocking potential in our current operations, and the addition of our secondary milling and flotation circuits, the MF2 projects at both Tweefontein and Lannex during the next 2 financial years is certainly going to contribute significantly towards even improving that profile further. Tweefontein forecasting to commission by about at the end of this year, from December onwards, and Lannex about the same time in the next calendar year. So that would bring us to about the ounces from 2024 to 2025 financial years to between 72 and 75,000 ounces, which is, I think, a very good progress. Without touching on the detail that we already mentioned, I think maybe worth just noting on this slide, where I've tried to give a bit of a comparison of the previous financial year challenges highlights compared to what's going on. I think we haven't touched much on the tailings dams at the moment. We are having to get new tailings deposition facilities at both Mooinooi and Doornbos constructed and commissioned during the next 2 financial years. And that's primarily to cater for the increasing production from our host mines. And as our host mines continue to generate current arisings and run-of-mine material, we need to create additional space for the tailings. it obviously has the benefit that we then get more material retreating to extend the life of mine of our operations. So we have to cater for that, and that's part of our obligation in terms of our contracts, and just focus on that. And then secondly, just also our remaining cost focus across our operations to make sure we can address the current inflationary pressures. So turning our eye a bit to the basket, our pearl split and basket prices. I think first of all, as many as you are aware, Sylvania have quite an attractive exposure to the rhodium price, where our currently it was 11.5% average for this past financial year, and I think just over 12% in the previous financial year. But compared to typical UG2 and Merensky reefs, it's quite an attractive rhodium exposure. In saying that, as much as it's attractive and giving us the upside in the upcycle in the market, when we saw record rhodium prices in the 2021 financial year, it does also explain the significant movement and decline of the basket price over the past financial year. And you can see at the graphs at the bottom, that purple line is primarily the rhodium decline that has been driving it. I think analysts across the sector all grapple with a difficulty where we're not just dealing with pure supply demand fundamentals, and you also have to take a view on the socio-political issues, the war and conflict in between Russia and Ukraine. You take the impact of the recent COVID lockdowns in China, and general global fears about. Then it becomes difficult to forecast the metal prices going forward. However, if we look at the demand and supply fundamentals going forward, we believe those are still robust and strong. Palladium and rhodium still, in terms of their role as autocatalysts, should improve going forward, to the moment that you have car sales increasing again and improving. That demand for that would certainly grow again. And then from a platinum point of view, is the hydrogen economy, and the demand for platinum in those industries going forward is certainly very attractive and looking forward. So I think overall, we believe the PGM price is supported in the short to medium term because of the combination of the robust demand and also supply side pressures. Just to give you an indication of our various institutions' view, or forecast the market, we've included the three institutions we use frequently: Standard Bank Securities as our in-house bank and banker, Nedbank Capital, who's doing extensive coverage of the platinum industry in South Africa, and then also Liberum Capital as our nomad in-house broker. We looked at their views, and you can see, how they view the different metals over different years, and as expected, and depending on what view you take on the geopolitical impacts and on the supply and demand, these views vary. And for that same reason, we in our forward-looking financials, some of the indicative values in terms of EBITDA we give in the presentation, use August average as a base case, but then include the sensitivities, assuming there's different price forecasts, to just give you an indication of how EBITDA, for instance, can change by applying the different forecasts. So Luanne will discuss that later in one of her slides as we go through the presentation. So just saying that, let me hand over to Luanne in terms of the financial section, and I'll close off with some forward-looking slides at the end.
Thanks, Jaco. As you've already mentioned, the drop in the 2022 basket price versus the previous financial year has impacted our revenue and net profit for the year. We recorded $152 million revenue on 67,000 4E ounces, plus iridium, ruthenium, copper, and nickel. Cost of sales increased 13% to $61.8 million and includes both direct and indirect operating costs, as well as non-cash items such as depreciation and share-based payments. The royalty tax is the mineral royalty tax on the royalty attracting ounces, which decreased in line with the lower revenues and EBIT. And income tax includes tax on taxable profits generated by the SDO, movement in the deferred tax and dividend withholding tax on dividends declared by the Sylvania Metals operating entity in South Africa to Sylvania Platinum. Net profit for the year is $56 million and earnings per share 20.6 US cents. If we look at revenue in a little more detail and comparing it to the revenue recorded in the prior year, the variance is made up mostly of the lower basket price received, which had a $45 million impact. The lower ounces reduced revenue by $8.7 million. The pie chart at the bottom of the slide illustrates the percentage 6E revenue generated from the various metals, with rhodium still generating the largest portion at 56% of our revenue, platinum 21%, palladium 15%, and gold, iridium, and ruthenium the balance. Moving on to our operating costs. All of our operating costs are incurred in South African Rand and converted to US dollars at the average exchange rate for the reporting period. The cash cost per 4E ounce increased 11% year on year in Rand terms and 12% in dollar terms. The increase per ounce is mainly as a result of the lower ounces produced in 2022, as well as higher electricity costs, with a 9% increase in April, as well as higher usage as the MF2s came online, higher increase reagent costs, and the increase in spend on community upliftment projects. The forecast cash cost for 2023 to 2025 is converted at 16.70 Rand to the dollar. Despite our increasing costs, the company still remains in the lowest quartile of the industry cost curve, and we've included the Nedbank cost curve graph in the appendix for your information. It should, however, be noted that the cost reflected in this graph includes all capital. So it includes the capital spend on the upgrade of our mining assets and not just our SDO operating entity. Group EBITDA for the 2022 financial year was $82 million, in line with expectations and mostly lower as a result of the lower basket price. Based on a gross 4E basket of $2,642 per ounce, which was the August average, we're estimating a $80 million EBITDA for 2023, increasing in 2024 and 2025 on the back of higher ounce targets. Any movements in the metal prices or exchange rate will obviously impact the EBITDA going forward. The dotted lines on the graph indicate the EBITDA based on the Standard Bank, Nedbank, and Liberum price forecasts. We reported a cash balance of $121 million at 30 June, up from the previous year's $106 million. Cash generated from operations was $92 million, and the company paid $24 million in taxes. $16.4 million was spent on capital, $14 million of which was spent on SDO capital expansion projects, SIB and tailings dams, and $2 million was spent on drilling and upgrading of our mining asset resources. In total, the company spent $9.8 million on share buybacks, which includes the on-market buyback in May and June of this year, as well as shares bought back from employees in September and March. $22.7 million was paid in dividends, split between the 4 pence annual dividends paid in December and the 2.25 pence windfall dividend that was declared in February and paid in April. The board has declared an annual dividend for the 2022 financial year of 8 pence per ordinary share, and this will be paid in December 2022. As mentioned on the previous slide, capital expenditure for the year was $16.4 million. The new Lesedi tailings dam and MF2 plant were both commissioned during the financial year, and the construction of the Tweefontein MF2 commenced during this year. CapEx for 2023 is expected to be around $22 million, of which $4 million is planned for further upgrading of the mining assets, $6 million for stay in business, including the Mooinooi and Doornbosch tailings dam facilities, and $11 million on larger capital projects, being the completion of the MF2 at Tweefontein, the construction of the Lannex MF2, the fine chrome recovery at Lannex, and standby power at Milcel and Durenbosch. The 2024 to 26 capital forecasts are mainly for SIB, and these capital forecasts don't include any capital for growth projects, as these answers haven't been included in our current profile. Returning capital to our shareholders is a top priority. And as I've mentioned already, we paid the 4p dividend and the windfall during the financial year, and have declared the 8p dividend for this year. In total, we've bought back 55.8 million shares since 2015, and we've cancelled 18.9 million shares. And to date, including the 8p dividends that was declared now, we've paid out $71 million in dividends since our maiden dividend in 2018. Moving on to our ESG. We're very pleased to have released our first ESG report alongside our annual results this year. As reported in our prior year, Sylvania has developed our ESG strategy based on our company values and aligned our ESG approach with the UN Sustainable Development Goals and the 10 ICMM principles. Sustainability of our business is key, and we are committed to making a positive contribution in the lives of our employees, the industry, as well as our host communities. Our ESG journey over the past 2 years has evolved, and the report aims to provide all stakeholders with an understanding of the company's influence and impact on the environment, employees, and the communities in which we operate. This slide just summarizes some of the key information from the report, and I'll touch on a few of these in the next 3 slides. Under the environmental performance, alternative and renewable energy sources are essential to reducing our carbon emissions. Part of our process has been to establish current and future energy needs, securing the energy required to operate our plants currently, and then improving efficiency, with the ultimate goal being the reduction in and replacing of Scope 1 and 2 energy sources over the next 3 to 5 years. We have a number of initiatives in progress to reduce the emissions in the short term, including the investigating of synthetic fuels or biodiesel for generators, minimizing land clearance and disturbance wherever possible, management of non-mineral waste, and the possible implementation of solar and or gas at our administrative buildings and change houses at all of our sites. Water is a precious and scarce resource, especially in the drier parts of South Africa. Our approach to water management is two-pronged, being the reduction in water usage, thereby conserving this precious resource, but also securing sustained water supply at operations where this has been a challenge in the past. The very nature of our business, being that the retreatment of tailings is good for the environment, and through the extraction of chrome and PGMs from tailings arising from our host mine, we reduce the impact on the environment. Our social performance, we have focused on 4 main areas under the social banner. The first being women empowerment, and that's both in the female representation in the workplace and upskilling of women in our host communities. Women currently represent 20.9% of our workforce, which is up from the 19% we reported in the prior year. Secondly, health and safety. We're very proud of our safety track record, achievements, and the awards which Jaco mentioned previously at Durenbosch, and we continue to strive for safety excellence. We've also recorded no Section 54 stoppages or 55 notices in the current financial year. We launched an employee wellness program, and this gives employees, their immediate family, and persons living in the same household free access to support services, counselling, financial and legal services. Training and development has grown year on year, and in addition to training and developing our own employees, the company offers internships and learnerships to people living in the local communities. We also have community support and upliftment programs. Where possible, local communities are given preference for new and vacant positions at our operations, and we've employed 64 new local community members this year. We have a number of outreach and upliftment programs, which include feeding schemes, education projects, a borehole water project, and campaign sponsorships, including gender-based violence campaigns, safety, and environmental campaigns. We've invested a total of 77 million, or about $5 million, in local community through procurement spend. Sylvania has also contributed $2 million for the financial year to the South African economy through the payments to employees, taxes, and both local and greater community, local and greater procurement. In 2022, we developed our ESG reporting toolkit, which established a set of criteria and baseline data to help us map our ESG journey. We've also drafted our SHE and ESG framework policies. We've launched a number of ESG awareness training campaigns and included ESG-related aspects in the induction program for new employees, which has helped roll out our ESG strategy in our organization. And we've embedded this strategy in our daily lives. We pride ourselves on our clear and transparent reporting, and through open and honest relationships, we remain accountable to all stakeholders, and legal compliance is critical to our operations, whether it's exploration, processing, or rehabilitation. ESG is a way of life at Sylvania, and we look forward to providing you with further updates as we progress.
Thank you, Luann. And now that we've looked at the historical performance of the company and we've addressed the past results, let's just have a look a bit of what you can expect going forward from us in this next financial year and beyond. So firstly, in terms of our strategy and the value drivers, in order for us to ensure that the company remains in a position to continue to generate attractive cash profits from our operations, and in order to fund our working capital, fund growth, and fund our identified project pipeline, it's important that we look after the current business and ensure that we can continue to produce as we have done over the years. And the two pillars of ensuring that is firstly making sure that we maintain a safe and profitable production environment, and that's looking after all our health and safety initiatives, making sure we maintain a disciplined safety culture, and also ensure operational excellence and make sure that the new projects we bring online are probably optimized. And as I indicated earlier, we are looking at about 68 to 70,000 ounces for the next financial year. But as the identified projects come online towards 24-25, we could increase that to between 72 and 75,000 ounces. Again, 4E basis, it's close to 100,000 ounces on a 6E basis, if you would again look at some of the industry disclosures. The second part, very crucial to our operations, is maintaining our license to operate. And as you've seen and heard now, and at quite a detailed coverage of what we're doing in ESG, we certainly have it as a primary focus area, and I think we are performing very well in terms of our progress and rollout of ESG throughout the organization. And then secondly, making sure we maintain those relationships with our key stakeholders, the communities in which we operate, our labor, which has been excellent relationship over the years, and then also in terms of our host mines. And then from a tailings standpoint of view, as I mentioned earlier, is making sure we get our permitting and designs in place in time so that we can cater for future production. Then looking at growth of the business, there are two pillars in terms of generating growth and value going forward. The first one is unlocking value from our existing and owned assets, and first of all, continuing R&D and optimization on our existing Sylvania dump operations. And I think over the years, the value we've unlocked with the rollout of the MF2 circuits, the rollout of fine chrome recovery circuits and classification, and those all assisted significantly towards our profitability and stability over the years. And then secondly is focusing on our own exploration assets. And as I said earlier, those are the exploration assets that we have acquired in 2009-10 already. But we haven't progressed over the years because of the prevailing PGM market prices. But in the recent years now, we've launched various initiatives to make sure we can understand the value better and unlock it, so in order to generate the best return to shareholders. And then the second pillar of this growth is to continue to look at external growth opportunities. And the big thing there is that we replicate our proven and successful business model we currently have. We leverage our current expertise, skills, and reputation in the industry of delivering on our promises and being a stable producer over the years to add value to third-party material and engage with third-party material. And we have a number of parties we're currently engaging with on an exclusive basis and quite far advanced in terms of evaluating potential of those projects. And on the next slide, I'll deal a bit more about that. And then obviously, as a continue to also look at additional ROM sources going forward. So to give you an indicative idea of what potential future projects can add and when you can expect, we've just indicated those different areas for growth that I explained just now. And the first one is looking at the top line, and that's primarily the existing SDO operations. And that's especially in the short term, the less than 18 months, you can see that Tweefontein and Lannex MF2 is coming online. We're already taking some third-party dump material on in terms of supplementing grade on some of our operations. So those agreements and is in place, those projects in execution, and that capital provided for in our current capital profile that Leanne discussed on earlier. So that will carry on, and longer term on our dump operations is focusing more on the fine chrome recovery and further improvement in PGM potential, so that we could maybe unlock potential in some of the current treated dumps, which is would otherwise be sterilized, to say, can we improve the grade further by removing the chrome so that it becomes a future potential feed source. So that we continue to investigate through our R&D efforts. Then coming to the growth from still sticking to the same business model from our chrome tailings, run-of-mine chrome ore, and current horizons perspective is our engagement with other stakeholders, as I mentioned. And we believe that in the next 18 months to 3 years that there are potential projects that could come online, and we're investigating. So if we would be happy or successful with the commercial terms of it, as I said, we've already done substantial technical and commercial and legal due diligences. You could add between 10 and 15,000 ounces a year for each one of those opportunities, and we're particularly targeting the eastern and western opportunity at the moment. And then obviously carrying on beyond the 3 years and going forward is looking at detailed exploration programs to identify more resources. And then finally, slightly different from the core skills and strategy in terms of dump retreatment is the primary platinum owned exploration assets. And as I said, those are assets we've owned for more than 10 years already. But we didn't pursue initially. Our strategy was a very high capital, high risk approach where we would need our own refineries and smelters downstream, which does not fit our low risk and innovative approach to our business. We then launched several studies to say, can we look at upgrading the resources so that we can get a saleable concentrate grade so that would eliminate the need for expensive and risky downstream infrastructure. And that's exactly what we've been doing in the last 2 to 3 years. So in terms of both our Northern Limb assets, which consist of the Aurora and Acro resources, and our Volspruit resources, we are looking at publishing updated resource statements in say the next few weeks to a month. And on Volspruit it would be on the northern pit of the operations, and on the Northern Limb resources, we've identified a trial area that represent about 10 to 15% of the total strike length we own there, to prove for a proof of concept. And based on that, we are doing our planning in the next 18 months to progress Volspruit's current preliminary economic assessment, which we're waiting the final report, to a pre-feasibility study and feasibility study if it all is positive. And then the Aurora section, which form part of the Northern Limb, we want to progress to a scoping study. While we're doing all of that, as I said to you earlier, we've owned these assets for a long time, and we own the mineral rights. So obviously, we have the pressure of showing progress in terms of our approach and say, listen, are we going to mine it, or are we going to create value in an alternative way? Once we know what the feasibility or economic potential of these projects are, we can take a decision and say, is it worth spinning these projects out and taking that cash and reinvest in further dump business? Do we partner with maybe one of the bigger PGM producers who has the track record in mining skills? As I said, these are open cast surface operations, so low risk, low cost, attractive mining projects, which would utilize exactly the same metallurgical skills and experience we already have in our dump business. So that we would be able to, the metallurgical side, replicate straight across. So a partnership could well work with it. And I think the unlikely option, but still the option you have to evaluate, is say, would you look at development going further? Again, just being indicative in terms of timeline and the profile is each one of these projects, Volspruit and then the Northern projects, could each add approximately 70,000 to 120,000 ounces a year. So in other words, doubling the capacity of the existing Sylvania, if you on fully attributable basis at the moment. But it is in the 3 to 5 year window of execution. So it's just to give you an indication of what are the different opportunities in that regard. So just to close off, then looking at the outlook going forward, as I said, we have a proven track record. We will continue to deliver sustainable shareholder value, and we'll continue on our combination of issuing dividends and share buybacks as and when the opportunities arise. We have longevity in our operations. As I said, we have operational life beyond 10 years on just the current resources, and with the current growth prospects and our growth aspirations, we're pretty sure that we'll be able to extend that even further. In terms of profitable growth, I explained on the previous slide just the strategy, how that ties in, and focusing then towards a PGM market, and that we, as I said, remain cautiously optimistic. We do believe the fundamentals are robust and supporting the price. And then in terms of the ounce guidance, as I said, 68 to 70,000 ounces we're targeting for the current financial year, and then from 2024 onwards, we're looking to increase above 70,000 ounces 4E or 90,000 ounces 6E. So yes, that is, I think, a wrap, Paul, from our side of the presentation, and I would be happy to take some questions. Thank you.
That's great. Thank you, Jaco, and thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. And I'd like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jaco, we have received a number of questions from investors, and if I may, I will start with the first one. Have you any plans in the near future to use some of your cash balances to buy back further shares in the company?
Thank you, Paul. I think we've over the years had a strategy of balancing share buybacks at the times when the board believes there's opportunity for us in terms of the value in our shares, and also balancing off against dividends. We're obviously very cognizant of the fact that some of our shareholders prefer a dividend and others prefer share buyback, and I think it's due to personal tax preferences. So we try to have a balance of both. The philosophy still remains the same. It's a utilization of our available cash resources. So we, similar as our dividend policy states, we have to satisfy the requirements that we have additional working capital, provided that we have sufficient capital for our identified capital projects rollout, that we can honor our commitments in terms of the growth opportunities and aspirations we have, and then also to keep a healthy margin for unforeseen circumstances. I think we've been able through the years through COVID and through the current economic uncertainty to buffer any unforeseen circumstances. So I think we would continue to maintain the same balance. As I said, we would maintain a balance between buybacks and dividends as and when it satisfies the criteria for us to distribute additional cash.
Fantastic. Thanks, Jaco. Next question we've got here. The problem with the Eskom rumble on, has the board done anything yet to protect the company from these issues?
Look, I mean, it's a constant consideration of the board. It's definitely featuring high on our company risk register. It's a primary focus point for us all the time. I think considering the escalation, it may be important to highlight something. So I think a lot of time what most investors would see, and most of the individual or household consumers actually see the load shedding impact, and especially the impacts on smaller businesses. We are shielded to an extent from the direct load shedding through the industrial customers relationships like our host mines have with the power utility. Because they can manage the demand on the smelters on one side, they assist the utility to manage power in those load shedding periods, and in return for that, the mines are normally not load shed or disrupted because they absorb that impact on the smelter side. And with us being located in the mines, we don't have necessarily disruption to the same extent as private consumers and small business have. However, same as a lot of the companies in the industry, we have sporadic incidents of vandalism, cable theft, supply, substation disruption, primarily to get copper from the bus bars and the cables. And those interruptions do impact on us. Based on our then analysis of those disruptions for the past few years, we have committed capital in this current financial year at our operations most significantly affected to put in backup power generation capacity. So Millcell and Doornbos would be the first two operations that have that. Tweefontein has a full backup power generation capacity, and that's why one of the reasons Tweefontein has been our flagship in terms of stability and performance over the years. And then I think looking at the country as a whole, the government have just announced, in this last month, that they are looking to the threshold they've put on IPPs or independent power producers to produce energy, which was initially 1 megawatt, moved up to 100 megawatt, and the government are looking to do away with the limit altogether now, which certainly bodes very positive for the industry as a whole. And I think if you look at the Minerals Council of South Africa's communications over the last few months, talking to their various mining clients, it seems like there's a number. I think they've quoted close to 70 individual projects identified already to bring significant additional power capacity online. So we do think that overall, we're keeping a close eye on power risks. And as I said, we have our own mitigating measures in place, and we're keeping a close eye on the developments within the industry and the country as a whole.
That's great. Thank you very much indeed. And I think something you have touched on, but do you see platinum prices rising in the near and medium term future?
Look, I think I did cover on that, and as I said, the fact that we primarily focusing on the use of our PGMs. We know palladium and rhodium are the bulk use is in automotive industry. We know the automotive sales have been significantly down, impacted by the global economy, both the impact of Russia, Ukraine. I think in Europe, people are worried about increased energy prices and inflation. Then you don't buy new cars. In China, they've had the COVID lockdowns recently with the new outbreak they've had, and then a lot of the factories have been impacted in terms of production. Those are all limits we think. If you look at some of the car sales forecasts going forward, a lot of the analysts are expecting that to improve, and that would obviously increase the demand again for the metal, and that's why palladium and rhodium in the medium term are forecasted to remain in deficit. But being that said, I think every investor have to. It's difficult. You can't just focus on the poor supply and demand fundamentals, because the social, political, and global economic parameters also impact on these prices. But as I said, we are forecasting. That's why we put the range in our prices. We forecasting. think the current outlook is robust enough for us to work on, and I do think there might be potential upside looking at some of the analyst forecasts.
That's great. Thank you very much. Next question we've got here is: in the past, I believe the material you process had an estimated 10-year life left. Firstly, is this the case, or do you think the opportunities available to you to acquire new clients can realistically, materially extend this horizon? And secondly, does the company have a realistic prospect of exploiting the mining rights it has to a profitable mine these, thus reducing the reliance on acquiring new reprocessing clients?
So I would answer it in two parts, because I think they're two different questions almost. The first one relating to the resource life. and as we indicated by that individual operation contributions in the production graph I highlighted earlier, we have different operational life on the different operations. Some of our operations have life extending beyond 15 years, and then others have a shorter operational life. And that's why we always say we believe that we have a combined profitable life of at least 10 years or beyond that in our portfolio, with the current identified resources, current mine plans, and current infrastructure. We do obviously looking at some of the potential from third parties, seeing that there are projects that can add 10 to 15-year new life on to operations, and then that's why we are pursuing these in detail. As I said, we have the right management structures in place, the overall infrastructure expertise to take on more opportunities, and that's certainly why it is a key focus area for us. Looking at the question about realistically expanding or commercializing the exploration assets, I think certainly looking at projects in the industry and looking at the longer term PGM demand fundamentals, there will be a need for future production. And then looking at the supply pipeline, there's a couple of deep level expensive projects in progress or in feasibility stages in the same area where we are. But I do think what makes our assets unique is that there's shallow open cast operations, so cheap mining cost and low risk, and the fact that we have done the work to upgrade the cutoff grades on the models to get us to a saleable concentrate means that you bring down the capital and the downstream processing risk significantly. Our idea with this is we're well aware, we've our processes, we have excellent metallurgical and processing track record, but looking at the open cast mining operations and the current operations we have, like the Mooinooi and Lennox, we are treating open cast operations that somebody else is mining for us in any case. So our plants are already treating run-of-mine material. We're already treating recovering the PGMs from it. So it's an ideal match to our current skill set and expertise. So processing-wise, it's fine, and that's why I said if we understand the potential of this, one will decide to say, okay, do you then partner with somebody on the mining side, like we are partnering with our current host mine, so that we can focus on our processing going forward and add significant value, or do you say, listen, it is not fitting the core skills and strategy of the company, you spin it out and you reinvest that money if you've been able to identify other third-party material in the dump space. So either way, the steps we're taking currently on exploration to understand our resource better, improve the confidence and the classification of our resources is definitely adding value to shareholders, because whatever step you take next will depend on the work we are doing now. That would unlock the value for you going forward. So I think certainly the projects are attractive, and they could be definitely, in my view, I think as a high prospect of realization in as commercial projects in the end. If we the guys taking it there or partnering with someone, that is a question that we can only answer once we have more of the detailed information available that is currently being performed.
Thank you, Jaco. Next one we've got here, is there any plan to commercialise the nickel resource at the Volspruit mine, or is this something that's being looked at, especially given the nickel is substantially increasing due to demand for use component in high energy density batteries?
Thanks, Paul. This question actually ties in perfectly with the previous one. Volspruit mine is one of the, so as I said earlier, we have Volspruit and then the Northern Limb project areas. So those would be two respective mining areas. So it's exactly what I've just been discussing to say the fundamentals for it is in terms of development. It could well be that you exploit it. So just then maybe touch on the nickel portion here that we have not discussed in the previous answer is, and I didn't mention it there. So while these are primary PGM resources, in contrast to our current chrome tailings or chrome run-of-mine material we treat to basically recover PGMs as a byproduct, while the host mines retain the chrome as their primary product. These open cast projects are primary PGM projects, and they're in the same geological area as Anglo Platinum's Mogalakwena operation, which is their flagship, lowest cost operation and biggest platinum mine in the world. So it's geographically located there. So those Northern Limb ores contain a significantly higher portion of nickel and copper. So the base metals, and yes, it is very attractive from that point of view. So and it is a big consideration, especially looking at the battery demand and alternative energy demand going forward. That said, it has then obviously slightly lower rhodium, or significantly lower rhodium content. You typically on our properties between 4 and 6% rhodium compared to 12% rhodium in our current suite. But you have the base metals almost 10 times the base metal content in the concentrate than our current SDO operations. So the nickel and copper certainly could be attractive, and but it's a careful balance in the industry finding the off-takers that are able to accommodate the base metal capacity in their existing smelters and refineries. But again, as I said, the studies we're currently performing would highlight all of those opportunities, challenges, and requirements for us to make a decision going forward.
That's great, thank you. Is the growth in renewable energy likely to increase the demand for platinum in the near or long-term future? And is that likely to offset the fall in demand due to the fall in use of catalytic converters?
Look, so you have to understand just the applications. So I think overall, there's a slight shift in which element is being consumed in the different areas. So while palladium and rhodium are currently primarily the autocatalyst consumers, or a large portion for palladium. Palladium have a portion of its consumption that's industrial, and that would probably continue to be strong going forward. So you might have rhodium and palladium going down as the traditional internal combustion vehicles are replaced with newer tech electric vehicles and also power, more renewable power. But then to counter that, in one part is increasing emission standards for this greener economy. While there's fewer cars, the catalytic requirements or the loadings in the catalyst becomes increasingly more. So that balances some of the demand. But then significant change, and you would see that on the graph I had, the PGM prices, looking at the long-term outlook for platinum. Platinum plays a major role in the alternative energy and renewable energy economy going forward, and especially the hydrogen economy. So platinum plays a significant role in platinum fuel cells, and therefore we're fortunate having platinum, in fact more platinum than palladium and rhodium in our pearl split. So if you have a drop in the palladium and rhodium prices going forward, we see platinum price significantly increasing, and as I said, looking at the exploration project, you have the further benefit of nickel and copper in that.
That's fantastic. Thank you very much indeed. And I think we've just got time, if we can get some quick answers, last couple that we've got through. What's the rationale for holding so much cash, especially the more volatile South African rand rather than, say, for US dollar?
Yeah. Look, so I think we explained earlier how do we decide how much cash to hold, and it's also part of our dividend decision is to make sure, firstly, we can, based on our current view of the global economic and world risk. So in the times of since COVID and also the current uncertainty with the conflict in Ukraine and other economic parameters, we did increase our standard working capital requirements from the 4 to 6 months already. So that plays a big role in what we do. We do have to cater for our identified project capital expenditure, and you've seen that we have the higher capital forecast for the next financial year for the specific projects Leanne mentioned. Then we further have to look at the growth opportunities which I identified, so we need to make sure we have that. And then the last one is making sure we have enough capital to pay the dividends that we declare. So we, in fact, at the end of this current financial year, 30 June, had more of our cash in dollars, US dollars, than we had in South African rands. But it's important to note that our South African, all our operating expenses are incurred in South African rand, and therefore it's important for us to keep an adequate holding of rand in South Africa. The rands that we do have in South Africa, we invest with reputable institutions at interest rate of about, I think, 4 to 6% in there. So it's not that whole philosophy. Leanne and her team is very diligently managing all the time to ensure we have the right balance of cash in the right place, and overall that the company, through the guidance of the board, holds the right amount of cash on hand.
That's fantastic. Just conscious of time, Jaco. So I think if I may, you have covered off a lot of questions we have from investors. Of course, the company will review all questions submitted today, and we publish responses to those on the Investor Meet Company platform. Jaco, before redirecting investors to provide you with their feedback, which I do know is important to you and the team, can I just ask you for a few closing comments, if I may, please?
Okay. No, thanks, Paul. And as always, it's a brilliant opportunity, and we said since we initiated the first session of the Investor Meet Company after COVID, it's been a unique opportunity for us to get exposure to a lot more shareholders and potential prospective investors through this platform. So thank you for that opportunity. So just closing on the company, I think as we explained throughout the presentation, like all PGM companies in the industry, both our financial performance and the share price performance is significantly dependent on what the PGM market does. I shared my views that we believe we have a robust outlook on that, and therefore we are quite upbeat about what the future holds. But each investor would have to apply his own set of assumptions and risk appetite to determine where they would place us in terms of future potential. However, and as I said, so what makes Sylvania unique is the opportunity, unique investment opportunity is the fact that we have a very attractive suite of very attractive and stable cash generative operations that gives us the opportunity to generate cash to invest in further growth and sustainability of the operations. We have a proven track record of delivering on our promises, and I think and of returning value to shareholders, and by leveraging on that and just continue to do what we have been doing to date, I'm confident that we would be able to unlock significant further potential for shareholders, both from new opportunities, growth opportunities, and from our exploration assets going forward. And I hope that the shareholders feel that they get the same value as we believe we are delivering. So thanks again for the opportunity, and as I said, we'll get back on some of the questions that we haven't been able to answer now in writing later. Thank you.
Jaco, thank you indeed for updating investors today. Can I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback, and all the team can better understand your views and expectations. This will only take a few moments to complete, and I know is greatly valued by the company. On behalf of the management team of Sylvania Platinum Limited, I'd like to thank you for attending today's presentation. That concludes today's session. Thank you, and good afternoon to you all.
Thank you.